Hello, this is Brother Kimball and welcome to Module 3. This first part of the module you should be able to handle based on the videos. I simply explain the differences between a manufacturer, a wholesaler, a retailer, a service provider, and a hybrid. First one just simply asks, what kind of business would you like to work for or create someday? It's easy to answer enough. Number two, now classify the business above as one of the following. So you've identified a business that you might be interested in, and then you just kind of classify it. Next, you're going to look at this balance sheet. And what I want you to do as you look at this balance sheet is I want you to determine whether this is a balance sheet for a manufacturer, a retailer, a wholesaler, and what you can do is just look at the different types of assets and liabilities that this company has, and I think it will give you a good idea which one we're talking about. Okay, so that one should be pretty straightforward. The other information, just use your logic, just do the best you can. I tell you how to compute the debt ratio, which is your total liabilities divided by your total assets, so you should be able to compute that, and we're going to compare the two. Which company is more highly leveraged? The idea of leverage means they have more debt in relation to their assets. Leverage means they're using debt to leverage the small amount of equity that the owners put in. As there's less equity and more debt, that means there's more leverage. The owners' contributions are being leveraged through debt, so that should help you up through number 6 here. These others, just read the question. I think you can handle those. This last one is a little tricky. If both could be sold for a total of $500, which company do you wish you were the owner of? In some ways it's kind of tricky because you don't really know what their business is and how they've done in the past and stuff like that because you only have a balance sheet. But if you're just focusing on the equity and which one has a higher percentage ownership of the company's resources, that might give you an idea of which one you'd rather be the owner of. Which of the companies has been the most profitable? This one's a little tricky because all you see is their equity now, what their retained earnings are now, but you don't know what their income has been in the past because some of it could have been contributed. So I'll let you think about that. Moving on. This next one, review this income statement and determine which one is likely a retailer. So once again, look at the different items, read the names of the different items on here, and try to imagine which one is a retailer and or what other type of business they might be. Okay, which one might be a service provider, for example. Okay, think about what this means. What does it mean for this financial statement to be for the year ended? And I guess I've already typed the answer here, so lucky you. Okay, keep going. Which company is generating more earnings for its stockholders on a per share basis? That would mean you'd have to take the income and divide it by the number of shares outstanding, and you can compute that. It's based on a per share basis. Continuing on with Mod 3.2, this is about the management cycle. Okay, and that's straight off of the videos. So I won't spend a lot of time on these. I think you can get that off of the videos. The difference between financial and managerial accounting. The 5 key financial transaction cycles, it's right out of the videos. You should be able to handle that. Okay, now this is one that might take a little more effort. What I'm trying to do is I'm emphasizing this idea of the balance sheet equation. Okay, and I'm going to put this plus here and minus there, and plus here and minus there. As you know, pluses indicate that you have more of that particular item, and minus means you have less of that particular item. So if you get more assets, you're going to increase on the left and decrease on the right. So if you have 10 here and 3 here, and you want to know how much cash you'd have, you'd say 10, which is the plus side, minus 3, the minus side. You would draw a line and say you have 7 in cash, for example. So we have a few assets listed, and we have a couple liabilities listed. And then under equity of our contributed equity, where owners gave cash, increased cash, and increased capital stock, their equity in that cash. And then you have the earned equity, because these are all the net income, which rolls up and becomes part of the retained earnings, and it's reduced by any dividends or expenses, for example. All right, So the reason the dividends and cost of goods sold are increased on the left, although they're equity accounts, they're actually negative equity accounts. You see this? This is minus dividends, minus cost of goods sold. So these are negative equity accounts. These are temporary equity accounts which get closed into retained earnings on the balance sheet at the end of every year, so you can start the next year fresh. So the way you handle a problem like this is you just read it and you ask yourself, what did this transaction do to assets, liabilities, and equity? Let's do the first one. You have Jinghua and Mosiah, and they contribute $2,000 each. Don't overlook that each. So in other words, they contributed $4,000. So you can go like this, and you can write down $4,000. So assets increased $4,000. And now you've got to ask yourself, when they made this contribution, did it touch any other asset? So maybe one asset goes up 4,000, the other one goes down 4,000, keeping this in balance. Or did cash go up, causing assets to go up, and another liability went up 4,000, so that had to be a 4,000 on the right hand side, 4,000 here, 4,000 there, keeping in balance. Or did equity go up? In this case, since it's the owners who contributed the equity and they received shares in the company, we would say they have more capital stock. So if you were to compute how much in assets we have, we would say we have 4,000 in assets now, no liabilities, and 4,000 in equity. Okay, so that's what you're going to do. You're going to go through each one of these. Okay, we borrowed $300 from the bank. Now, which assets were affected? Which liabilities were affected? Which equity affected? And sometimes only the asset side's affected. One asset goes up, another asset goes down by the same amount. Other times, you have one asset going up and a liability going up, or one asset going up and equity going up. And so what you want to do is you want to read this and you want to ask yourself, did this affect assets? If it affected assets, total assets, then that means if total assets increased by 300, then one of these others must have increased by 300, or the combination would have increased by 300 to get that to balance out. All right, so this is very similar to Module 2, and I hope by working through this you're getting a feel for this tool which we use to then later prepare the financial statements. These T accounts are effectively ledger accounts which help us know how much of each item we have, and we then can determine our total assets, liabilities, and equity. We can determine how much income before taxes they have, which would be our revenues minus our expenses. We could determine how much income tax expense should be computed on this net income. We could then say, hey, if they received dividends and they're taxed on those dividends at 30%, how much tax they'd pay. Okay, so I hope that this was helpful in preparing you for this module worksheet, and I wish you all the best. Aloha.